Hey guys, I'm Manisha Gupta and we're putting limelight on the crude oil prices right now, where we have seen prices trading at a 7-year highs, hitting $90 per barrel for both the crude varieties, and it has been a week-on-week rise coming in for the crude prices. So much so that in last couple of months we've seen nearly 26% of gains come in for the crude prices. What does it mean for India, which is a major consumer and an importer of crude prices, and our dependency on imports is nearly 80%. In the last 2 months, we have seen the prices gain up by nearly 26%, and in the last 2 months, we haven't seen India hike prices for petrol and diesel, and this perhaps is ahead of elections. So what does it really mean? To put forth all of those questions, we are now joined by Vikas Halan. He's Associate MD, Corporate Finance Group, Moody Investor Services. Vikas, hi, thank you so much for joining us. With both the crude varieties at $90 per barrel right now, how do you look at this run-up? Is it supplies, geopolitics, speculative trading? What category or bracket are you putting it in?
Thanks, Manisha, for having me. Yes, $90 at last, who would have thought. Both Brent and WTI, which means that the gap between them has narrowed down very significantly. However, this is not driven by fundamentals. The $90 is, as we see it, is a reflection of the geopolitical risk and the number of scenarios that the producers and consumers are incorporating into their price expectation of a number of geopolitical scenarios that are going around.
So, because what is Moody's sense in price forecast for the crude prices, and how much of a geopolitical premium are you putting on the current levels right now?
Our fundamental view on oil prices haven't changed. We continue to believe $50 to $70 is where we should have a long-term price clearance, and anything above that at the moment is a function of both the evolution of the pandemic, demand-supply imbalances, as well as geopolitical risks. So once the geopolitical risks subside, we should get back to more longer-term averages as the pandemic situation becomes more clear and demand and supply rebalances. So let's not forget, in addition to geopolitics, there's also OPEC, and within OPEC, there is a member of OPEC that has geopolitical risk associated with it. So it's very difficult to separate these two issues. The geopolitical situation is kind of playing into the demand and supply dynamics, and that is why it is hard to separate the two. But as I said, the long-term price average that we think is sustainable for oil prices is 50 to 70, and we are clearly $20 above the high end.
You spoke about OPEC, Vikas, and OPEC has been increasing production by 400,000 barrels per day every single month, and that goes on for the month of March as well. But we haven't seen OPEC being able to produce that kind of numbers. It always has been about over-compliance.
OPEC can decide to increase production, but at the same time, if they don't produce, that's not going to help anyone. So, the compliance on the upside has been somewhat underwhelming at the moment. And as I said, OPEC is not untouched by geopolitical risk. So on one hand, $90 does suggest that there is clearly a demand-supply balance in favor of suppliers at the moment, and the suppliers need to do something about it in order to maintain price stability. But that will require resolve on the OPEC members to increase production, at the same time compliance. Both of these will be tested in the coming months, especially when governments around the world are focused on taming inflation, whether OPEC acts too fast, increase production, and then when the interest rates increase, there's a downside to growth, and then they roll back. So they don't want to be in that position as well. So there's a very fine path that they need to sort of walk over the next few quarters and monitor the market, both on financial side as well as on fundamental side, and not to forget the geopolitical risk.
And then, because there are a couple of factors at $90 per barrel for the crude prices, one, you will see reaction in sense of higher production for many of the producing countries. And on the other side, it would also perhaps give a push to the renewables that perhaps would be preponed earlier than time with such high prices, would you say?
Absolutely. I mean, that's exactly the kind of thinking that is going on at the moment. And that's why I said, $90 is not sustainable for oil. Even the oil producers don't want it to sustain, because that just makes the case for renewable that much stronger. So, once the inflation fears are subsided, would you want the oil prices to remain at $90 as well? The answer is definitely no for oil producers. They don't want the renewable to be more attractive and result in a much faster energy transition. We are heading towards energy transition one way or the other, but if you keep oil prices at 90, you are going to get a much faster energy transition.
Because my final couple of questions are very India specific. Here in last couple of months, even as the crude prices have gained in the month of December and especially January, where we have seen 17% of gains, India hasn't moved, budged in sense of petrol and diesel prices upside or down. And this perhaps happens ahead of elections. Is this ideal? What does it mean for OMCs?
It's very interesting because on one hand, if you don't increase prices, it does create demand-supply imbalance, right? So if India is a big consumer and the prices don't go up, the demand do not adjust, and that sort of feed back into the suppliers. It goes into the hands of suppliers that they can keep squeezing on the prices. On the other hand, if you look at the longer-term view, elections are definite that they will happen at a certain point in time, and then there is adjustment. This is not the first time that is happening. It is coinciding this time at an increase in prices, but let's not forget India is used to importing oil at well over 100. Right now, you have oil marketing companies that are not getting the subsidies and are taking on the hit on their P&L. But once the elections are over, we have seen that they are able to make up for whatever losses they make during this period. So overall, it's a short-term issue. It's not something that will linger on beyond elections and will sort itself out. India is in a much better position from a price regulation perspective than what it was 10 years ago, when prices were fixed and any increase in price would have been very difficult. But right now, those periods are just limited to elections. So I think, yes, it's not ideal, but it's much better than what it was.
So final question then, Vikas. So when India does come back after elections perhaps and starts adjusting these prices in the Indian markets, what manner do you see, one, adjustments happening, and two, how do you see this being passed to consumers? Is it going to be one go? Is it going to happen in phased manner?
There are a number of solutions. One, of course, is passing on the entire cost increase to the consumer, but we have seen in the past that that's not entirely the case. The government adjusts its own tax structure to accommodate, because when oil prices fell, the government increased the duties, and then when oil prices increased, the government reduced them. And that seems to be the path. There will be a portion that will get passed on to the consumer if the prices do indeed stay at this level. That's my expectation of the policy evolution, that it will try and distribute the pain rather than just having all the consumers facing the pain at once.
All right. Thank you so much, Vikas, for joining us today and putting a spotlight on all of those important points when it comes to crude and Indian petrol and diesel prices.